Hi everybody. So the big events this week will be the meeting of big oil producers, OPEC and non-OPEC nations, to decide future oil production for the next 6 months. We also have, because it's the first week of the month, we have non-farm payrolls on Friday. It's also the start of a new quarter, so we'll be giving our brief outlook for Q3. Now the backdrop to this is that we've had a huge rally in gold and Bitcoin. Equity prices have been pulling back somewhat. We've had a few days of declines, but we've had a pullback in the dollar. We've also had oil prices lift somewhat as we headed towards that G20 meeting at the weekend and towards this OPEC meeting. Before that, I'll just get into the economic calendar. So as we mentioned on the calendar here, it notes OPEC on Monday, but you should also know that we've got the meeting of the OPEC members, mostly Middle Eastern members, including Venezuela and a few others, but non-OPEC includes the likes of Russia and essentially members not officially part of the cartel, but part of this kind of quasi-cartel arrangement at the moment, who are all agreeing to cap output. Lots of PMIs this week. I mean, the backdrop to this, in my mind, if you're thinking in terms of indices, they've been rallying on the context of lower interest rates to come. So from that, you could probably take that good data is either bad for equities, or you think the rate cuts are probably coming anyway. So if we get a little bit of a pickup in the data, that's a kind of Goldilocks scenario where we've got the lower rates and the good data. So it really could be one of both of those scenarios for PMIs. Got the RBA decision. Looks like a rate cut based on Governor Lowe's recent dovish comments, but it would be the second consecutive cut, which is seemingly uncharacteristic for the RBA and probably a bit overzealous. It's not that necessary, in our opinion, in Australia, but let's have a look at how this announcement affects the Aussie. Non-farm payrolls, 75, a really poor result 75,000, that is, really poor result last month. It's not been a problem for indices. We've hit record highs in the US, has been an issue for the US dollar. We've had that weak data, plus the likelihood of interest rate cuts. The expectations 165,000 this time. But that said, economists have been in this 170, 180,000 prediction region for months, and in most months I've got it completely wrong. So let's expect probably a pickup from the 75,000 last month, but maybe not so much as to undermine the chance of a Fed rate cut. So do look out for our Q3 Outlook report. That's going to be appearing in your inbox soon. Will also be available in PDF form on the website. But I think we can probably mainly summarize the big themes for the upcoming quarter as very much similar to what we've had in the rearview mirror. So possibly an abatement, a pause in the trade war if things go to plan following this latest G20 meeting between Trump and Xi. We can also expect further Chinese stimulus, and not just the stimulus, but the effects of that stimulus in China, particularly inside in China's industrial base, but also its key import markets like Australia and the other Southeast Asian nations that benefit from a strengthening Chinese economy. Also, and probably biggest amongst all others, and this is something that has come about really in the last month or so, and that's been a big about turn from central banks. So it looks like the major central banks are no longer in their pause of a rate hiking cycle. In the case of the Fed, at least, they're now looking at cutting interest rates, and that includes the European Central Bank, who has already got zero and negative rates at the moment. So, and also, of course, the Bank of Japan. The only one that hasn't joined the party yet is the Bank of England, but obviously the UK has its own set of uncertainties through Brexit, and we are expecting the most famous date in the UK at the moment is October 31st, because that's the deadline for some sort of deal to be agreed between the UK and the EU. This time around, without the UK defaulting out without a deal. The British pound has been looking quite strong of late, but obviously where it ends up by the end of the quarter will be very much a function of Brexit. Our opinion being that at the moment, the British pound is not even so much focusing on Brexit. It's looking at this Tory leadership contest, and it's looking at the likely contenders of who take over the leadership and what their likelihood is of fending off the Labour Party in another general election. And that's why the markets are generally reacting quite positively to Boris Johnson being up in front, because he seems like the most likely candidate to beat Jeremy Corbyn in a general election. So more thinking about, I think, in markets that Brexit's still very much uncertain, but what is quite known is that the Labour Party in its current form quite unfriendly to business. So looking more from that prospect, and probably if you do look at the Brexit scenarios, it seems more likely there would be a general election, then potentially a second referendum, or just some sort of deal made. Two fairly positive scenarios for the pound versus just the one no deal scenario, which is the negative outlook for the pound. So Brexit being the big one for the UK, but obviously, as we said, the trade war and dovish central banks being the main thing that would be driving markets, we think, in Q3. Now, just to address this OPEC meeting that we have on Monday and Tuesday more specifically. So if you remember at the last meeting, OPEC and non-OPEC agreed to cut 2 million barrels per day from their pre-agreement levels of output. Those levels of output were close to record. So they're still pumping a fair amount, but they are just capping it. They are trying to control the supplies at the moment. The expectation is that they will just continue at the same level of production. And I think if you just on the most simplistic analysis possible, if you look at the oil price, it's around $65 a barrel at this point in Brent. That's almost the midpoint of a range. You know, if you're talking about 40 being too low, 80 to 100 being too high, it's kind of in that happy place where neither consumers nor producers of oil are being too badly hurt. Some of the weaker OPEC nations are actually pushing for further cuts to try and drive output higher. Algeria, for one, has been cutting for higher. They've been pushing for more cuts in output. Obviously, lower supply means generally the higher price, but that would most likely unnecessarily anger President Trump, who has been pushing for OPEC to increase production. And that is obviously another possibility, that OPEC unwind slightly or completely the 2 million barrels per day cuts that they had already agreed. And it's actually worth noting that they've been, because of extra cuts from Saudi Arabia, it's been more like 2.5 million. And then when you include the sanctions on Iran and Venezuela, that has been quite a lot of oil coming out of the market. So there is some justification to make up for those sanctions amounts, and increase production a little bit into what they'd previously cut. So if, as all happens as expected, then oil prices then probably going to be more a reflection of US supplies rather than the supplies from OPEC and non-OPEC, which we will know will stay the same, and a function of global demand, which is largely centering around the trade war at the moment. Right, that's it for the video this week. Thank you very much for watching, and if you do enjoy these videos and want to see them as soon as they're released, then please follow myself and LCG on YouTube and social media.